So for the last 40 years or so, investors have grown accustomed to bonds being a stabilizer of sorts for portfolios. If you think back when the stock market has a bad day or a bad year, the bond market, especially government bonds, sometimes they'll go up, sometimes they'll stay flat, but they generally will stabilize your portfolio. But why, we have to ask ourselves, why was it so easy? And if you think 40 years back, interest rates were about 14% on the government bonds. So if you lock those in, it's hard to make a mistake because rates eventually went down to 12 and then to 10. So you look pretty smart to buy bonds in the teens. And then interest rates went down to 8. So if you bought them at 10, you looked pretty smart. And then they went to 6, and then 4, and then 3. So any time in the last 40 years that you've bought bonds, you just had to wait a little bit and you looked like a genius. When COVID hit, the 10-year government bond got down to 0.4%. And we have to ask ourselves, can't go any lower. I mean, it could sit around low like the Japanese bond market did for the last 30 years. But it also could do something like rise, similar to how it did in our country in the 60s, 70s, and early 80s. And that, instead of having a tailwind for bond investors, we would have a headwind. If you look at the bond market in this last year, it's down about 9–10%. That doesn't seem like a stabilizer anymore. And it gets a little bit worse because if you look at the real interest rate, which is inflation minus the rate, maybe we're making 3% on some bonds, but inflation just hit 8%. So you're basically guaranteeing yourself a loss this year of 5% if you've just gone into the bond market. The question is it going to persist? And the answer is we have no idea. Some people think inflation is going to be with us for a decade. Some say it's going to be transitory. One hint that I think is out there is that governments around the world have a lot of debt, the US in particular, and the easiest way to pay that back is to kind of let the dollar erode, let inflation go a little bit hotter, keep the interest rates low, but let inflation go beyond that. So that's a worry. Printing all those dollars, that's a problem. Hopefully it won't be a problem like, throughout history, there's been many countries that really overdid it. I keep this around. This is a Zimbabwe dollar. Actually, it's 10 trillion Zimbabwe dollars to show you that it's pretty easy to stamp the word million or billion or trillion on a piece of paper. Now, we don't think that's going to happen to the US, but even a little bit of inflation can really erode investors' net worth over time. So what do we do for defense? Well, you probably should have started a couple of years ago. We were buying some gold a few years ago. We bought a decent amount of commodities in the bond accounts as a little bit of a hedge. So in your bond accounts, you should be very careful, probably not locking in rates for the long run if we think rates are going to keep going up. You can be tactical. If you think, we're heading into a recession, maybe you do buy some longer bonds temporarily and then sell them. Don't hold them to maturity. So I think it's going to be a much more complicated endeavor investing in the bond market over the next decade, really.